For decades, COMEX operated on a beautiful lie. Less than 1% of precious metals futures contracts actually resulted in physical delivery. Less than 1%. Everyone traded paper, settled in cash, rolled contracts forward. The metal was theoretical. The profits were real. And the system worked perfectly because nobody actually demanded the physical goods. Then 2025 happened. August 2025. Gold delivery requests on COMEX hit record levels never seen before. Every contract in August stood for delivery. Over 20,000 contracts representing 2 million ounces of gold valued at billions, all demanding physical metal. And silver? In the first 5 days of August, 1.72 million ounces were delivered, while 1.89 million ounces were withdrawn from warehouses. More metal left the system than entered it. That's not a market. That's a drain. By December 2025, the situation went from concerning to critical. Over 47.6 million ounces of silver were claimed for delivery in just 4 trading days. That's more than 60% of COMEX's total registered silver inventory gone in 96 hours. Not gradually, in 4 days. And here's the number that should terrify anyone holding paper silver. COMEX registered inventory, the metal actually available for delivery against futures contracts, currently sits around 113 million ounces. But open interest, the total outstanding contracts, represents 650 million to 900 million ounces, depending on the month. Do the math. If even 20% of contract holders demand delivery, COMEX is short by 17 million to 67 million ounces. The metal doesn't exist. The exchange would default. This is the 2% delivery ratio breaking. The system was built on the assumption that 98% would settle in cash. But when that ratio flips, when 20%, 30%, 50% demand physical, the fractional reserve structure collapses. And what happens next isn't just a pricing event, it's a legitimacy crisis that could destroy COMEX's role as the global price discovery mechanism for silver. Let me show you the exact mechanics of how a COMEX default would unfold, what cascading liquidations look like, why force majeure clauses exist and how they'll be used, and what 3 scenarios play out depending on timing and severity. Because this isn't theoretical anymore. December 2025 just gave us a preview, and the preview suggests the main event is approaching faster than anyone expected. First, understand what registered versus eligible inventory means, because this distinction is everything. COMEX warehouses hold 2 types of silver. Eligible means the silver meets exchange standards for purity and form, but it's not available for delivery. It's stored in COMEX-approved facilities, but the owner has no obligation to deliver it against contracts. Think of it as silver sitting in a vault that happens to be COMEX-approved, but it's locked away from the market. Registered means the silver is available for immediate delivery against futures contracts. This is the only metal that actually backs the paper market. And as of December 2025, COMEX holds approximately 113 million ounces of registered silver against open interest representing 650 million to 900 million ounces. That's a backing ratio of 12% to 17%. For every ounce of deliverable silver, there are 5 to 8 ounces of paper claims. And that ratio is getting worse every month because metal is leaving faster than it's arriving. Why? Because once silver exits COMEX vaults, it rarely returns. To bring metal back into the system requires complete reassaying. Every bar must be cataloged by purity, serial number, and weight. It's expensive, it's time-consuming, and most importantly, owners who pull metal out have no incentive to put it back. They wanted physical, specifically, because they don't trust the paper system. This one-way flow creates a death spiral. The more people demand delivery, the less metal remains registered. The less metal registered, the more fragile the system becomes. The more fragile it becomes, the more people demand delivery to get out before it breaks. It's self-reinforcing collapse mechanics. And you might be thinking, but wait, can't they just convert eligible to registered? Sure, if the owners agree. But eligible silver belongs to specific entities who chose to store it at COMEX for convenience. They're not obligated to make it available for delivery. Reports suggest much of the eligible silver belongs to JP Chase and other major banks who are holding it as strategic inventory. They're not converting it to registered because they want to keep it off the market. When December's delivery surge hit, when 60% of registered inventory was claimed in 4 days, JP Morgan reportedly moved 13.4 million ounces from registered to eligible. They pulled it off the table, deliberately, to prevent it from being delivered. This is control. The largest silver holder can decide whether COMEX survives or fails simply by choosing whether to convert eligible to registered. And right now, they're choosing not to. So what happens when delivery demands exceed available registered inventory? COMEX has 3 options. None are good. Option 1, source additional metal. COMEX could buy silver from the spot market, have it refined to exchange standards, transport it to approved warehouses, and register it for delivery. This is the legitimate solution. But it has problems. Time. Sourcing large quantities of refined silver takes weeks, sometimes months. Refineries are operating at capacity. Delivery times are extending. During the December crunch, physical premiums spiked to $8 to $12 over spot. COMEX would have to pay those premiums to source metal quickly. Cost. If COMEX is paying $65 spot plus $10 premium to source silver, but futures contracts are settling at $65, who eats the $10? The exchange? The clearing members? The shorts who sold contracts they can't deliver? Someone pays, and that someone will fight to avoid it. And here's the real problem. If COMEX starts buying aggressively on the physical market to cover delivery shortfalls, everyone watching will realize the exchange doesn't have metal. Confidence collapses. Delivery demands accelerate. The buying itself proves the problem exists. Option 2, force majeure. This is the nuclear option. COMEX contract specifications include a force majeure clause. It allows the exchange to suspend physical delivery and force cash settlement if conditions make delivery impractical or impossible. Force majeure claims are typically reserved for acts of God, wars, natural disasters, but legal language is flexible. If COMEX faces delivery demands it cannot fulfill, they can invoke force majeure, claim market disruption, and force everyone to settle in cash at the futures price. Longs expecting physical silver get dollars instead. And here's the painful part. The cash settlement happens at the paper price, not the physical price. If COMEX futures are trading at $65, but physical dealers are selling at $78 because of scarcity, you get $65 per ounce cash. The $13 premium? Gone. You lose. This is legal. It's in the contract. Every futures trader agreed to it when they opened their position, whether they read the fine print or not. But using force majeure destroys COMEX's credibility permanently. Because once the exchange admits it can't deliver physical metal against contracts, why would anyone trade those contracts? The entire purpose of a futures market is price discovery backed by the ability to deliver or receive the underlying commodity. If delivery isn't guaranteed, the futures price becomes fiction. COMEX becomes irrelevant overnight. Price discovery moves to physical markets, Shanghai, London, Dubai, wherever metal actually clears. And COMEX becomes a casino for speculators disconnected from reality. The deal? We'll pay you 1.77 per ounce premium over the futures price if you roll your December contracts to March instead of demanding delivery. That's $8,150 per contract, or $65 million total across 6,816 contracts, representing 34 million ounces. Why would longs accept? Because if they refuse and COMEX invokes force majeure, they get zero premium. They're forced into cash settlement at spot with no bonus. The 177 premium is the carrot. The force majeure threat is the stick. This worked. For December, those contracts rolled to March. Crisis delayed, but not solved. Because now March 2026 delivery is setting up to be even larger. The longs who rolled aren't going away. They're coming back. And they're probably angrier and more determined. The can got kicked down the road. But the road ends somewhere. And when it ends, when negotiated settlements stop working because longs refuse the buyout, when sourcing physical becomes impossible, when force majeure is the only option left, that's when the system breaks. Now let me model what that breaking looks like in 3 scenarios, depending on severity and timing. Scenario 1, controlled default through force majeure. COMEX sees delivery demands for 200 million ounces in a major delivery month, let's say March 2026. Registered inventory sits at 90 million ounces. Shortfall is 110 million ounces. The exchange cannot source that much metal in weeks, so COMEX announces force majeure. All contracts in March settle cash at the futures price. Immediate reaction. Longs who wanted physical are furious. They sue. Lawyers argue force majeure was improperly invoked. The exchange claims market disruption. Courts will take years to resolve. Market reaction. Physical silver prices decouple from COMEX futures. COMEX futures continue trading, but the price becomes meaningless. Physical dealers charge $80, $90, $100 per ounce, while COMEX shows $65. The spread is the default premium. Long-term outcome. COMEX loses its role as the global benchmark for silver pricing. Shanghai Gold Exchange and LBMA become dominant. Physical markets set prices. COMEX becomes a sideshow for speculators who understand they're trading paper, not metal. Scenario 2, cascading liquidations from failed deliveries. A major clearing member, let's say a large bank holding massive short positions, fails to deliver against contracts. They're supposed to provide 50 million ounces. They can't source it. They default. Immediate reaction. The defaulting members' positions get liquidated. Their short contracts must be bought back to close. This forces buying in a market that's already tight. Prices spike. Other shorts face margin calls. Cascade begins. Margin calls force other shorts to cover. This requires buying silver at elevated prices. The buying pushes prices higher, more margin calls, more forced buying. This is the short squeeze everyone talks about. Prices could gap from $65 to $90 in days, then $120, then higher, as forced liquidation overwhelms available supply. Physical market impact. As futures prices explode, physical premiums narrow because futures are catching up to reality. But availability doesn't improve. Dealers still can't source metal. Industrial users panic. Anyone needing silver for production starts hoarding. Supply chains freeze. Long-term outcome: some clearing members go bankrupt. The exchange survives, but with fewer participants, less liquidity, and massive volatility. Scenario 3. Systemic crisis spreading beyond silver. The COMEX silver default triggers confidence problems in other commodity markets. If COMEX can't deliver silver, can it deliver gold, copper, platinum? Traders start demanding delivery across all precious metals simultaneously. COMEX gold faces the same problem. Registered inventory can't cover delivery demands. Force majeure gets invoked for multiple metals. The exchange shuts down physical delivery entirely. Everything becomes cash settled. Contagion spreads. LBMA in London faces the same delivery pressures. Their vaults are draining too. They might invoke similar measures. Suddenly, the two largest precious metals exchanges in the world are admitting they can't deliver physical commodities. Monetary panic. And when exchanges that handle gold and silver monetary metals for thousands of years admit they're just trading paper claims without backing, confidence in fiat currency systems wavers. If you can't even trust gold and silver exchanges to have physical metal, what can you trust? This is the nightmare scenario, not just COMEX defaulting, but the default exposing that the entire paper market for precious metals is built on fractional reserves that collapse under physical demand. The reset is forced. Physical metals trade in one market. Disconnected paper contracts trade in another, and everyone learns the difference between having a claim on silver and having silver. Here's where we are right now. December 2025 showed that 60% of registered inventory can be claimed in 4 days. That's a proof of concept. It demonstrated that rapid inventory drain is possible, and it revealed that the system's response is negotiated buyouts and converting registered to eligible. But those responses are temporary. The structural problem remains. Open interest vastly exceeds registered inventory. Delivery rates are rising from historical 1% levels to 20%, 30%, even 100% in some months. Industrial and institutional buyers want physical, not paper. The mathematics are clear. If delivery demands continue at December's pace, registered inventory depletes completely by Q2 2026. Maybe sooner if China's export restrictions remove another supply source. And when registered hits zero, when there's no metal backing the paper, COMEX faces its existential moment. Do they admit the system is fractionally reserved and force majeure everything? Or do they desperately source metal at any price, proving the paper price was always fiction? Either choice destroys credibility, and without credibility, COMEX has no purpose. The 2% delivery ratio was the magic number. As long as 98% settled in cash, the fractional reserve worked, but that ratio is breaking. August saw 100% delivery. December saw 60% of inventory claimed in days. The trend is clear. More people want physical, fewer trust paper. And when that ratio fully inverts, when 50%, 70%, 90% demand delivery, the system that's functioned for decades implodes. This isn't prophecy, it's math. You cannot deliver 650 million ounces when you only have 113 million. The numbers don't work. And every month, as metal drains from vaults, as delivery rates rise, as industrial users compete with investors for supply, the gap between claims and metal widens. COMEX is built on leverage. Leverage works perfectly until it doesn't, and we're watching, in real time, the moment when it stops working. The warning from December is clear. The system is fragile. Registered inventory is draining. Delivery demands are accelerating. And the mechanisms to prevent default, negotiated buyouts, converting eligible to registered, airlifting metal from overseas, they're all short-term patches. The question isn't if COMEX faces a delivery crisis. The question is when, how severe, and whether the exchange survives it. Because once 2% becomes 20%, once delivery demands exceed available supply, once the lie becomes impossible to maintain, everything changes. And those holding paper contracts instead of physical metal learn an expensive lesson about counterparty risk, exchange rules, and the difference between a claim and the actual thing. The 2% ratio is breaking. We're watching it break. And what comes next will redefine precious metals markets for a generation.